Most mining companies will tell you that as they don't control the gold price, they're not as focused on it as the general public or the investing public. I'll explain why. Miners can only control some of their input costs. Others are not also controllable. For example, labor costs we don't control. But we can, through proper negotiation, reduce costs on consumables, on durables, and we can also improve the effectiveness of our operations. So as the gold prices fall, the biggest onus on the mining companies is to reduce costs and improve efficiencies. In terms of why the gold price is falling, there are so many different theories out there. Some people claim that we're in a brand new paradigm. The previous paradigm lasted since the Second World War. Gold was an asset of last resort. People would invest in gold in order to protect their savings in high inflationary times when currencies were devalued, etc., etc. Gold, of course, is denominated in US dollars and to a large extent is linked to the value of the US dollar. Being that as it may, I think one of the contributing factors to the increase in the gold price in the first place was the arrival of new vehicles such as the exchange-traded funds. Previously, investors that wanted to have exposure to gold, whether as a hedge against inflation or whatever their objectives might have been, they had really only two opportunities. They could buy physical gold, or they could invest in the equities of gold mining companies. Physical gold is very simple to understand. However, it's more difficult to invest in gold equities because of the additional production risks, exploration risks, and a variety of other operational issues that complicate the investment decision. So the gold price increased very, very quickly. Investors found that investing in ETFs was much safer, perhaps, or less risky, to put it in a better way, than buying gold mining equities. And it was actually simpler than physically storing gold somewhere in a vault. And these ETFs proved to be extremely, extremely successful. Bear in mind that the launch of ETFs was something that the gold mining companies initiated through the World Gold Council. And in theory, a very good move in order to broaden the demand and the participation of investors in the gold market. While gold was increasing, the costs of mining gold were going up much, much faster. Mm-hmm. And this is something that even the investment community didn't fully grasp. Those costs went up faster than the price of gold. The assumption was that mining companies were very, very profitable in those years, starting in 2006 perhaps up to 2012. The reality was that it was a real challenge. It was a challenge to find large truck tires, a challenge to find even used milling equipment. And nevertheless, the expectation amongst many miners was that the gold price would continue to rise. Some people described the scenario as a perfect storm for gold. Recent experience tells us that this was a very short storm. It didn't last very long. And while gold prices have quickly plummeted, costs, regrettably, are not falling as quickly. Therefore, a lot of mining companies find themselves in a difficult situation. They find they have to reevaluate their reserves and resources as the gold price falls, because certain reserves and resources are not economical at $1,200 gold. And you can say that the market was caught by surprise. I think the fact that if you accept the premise that there is a new paradigm for gold and how to value gold, then it's not surprising because it's new, nobody could predict it. The old models were no longer relevant. I think the challenge for mining companies can also be described in the following way. While gold prices were rising, costs were also rising, and there was the expectation that the margins that could be earned would be never-ending. Part of the problem there was that a lot of companies declared their costs in terms of cash costs or all-in cash costs, and there was a tendency not to look at the broader picture. And only recently, in the last year and a half, have most mining companies realized that the investment community wants to see a more accurate or a more detailed reflection of the actual costs. So many companies are now providing their guidances and their financial results in terms of all-in sustaining costs. This is a concept that also includes long-term capital. It includes virtually the entire cost of mining, as opposed to simply reflecting cash costs, where deposits have a very high grade, cash costs tend to be lower. Where the mining methods, surface mining, open pit mining, much cheaper than underground mining. Therefore, many investors would read that a company has declared cash costs of X, whereas in reality, their all-in sustaining costs were much, much higher. So I think it was a cathartic moment in the industry. People realized they had to, not just for their investors, but for their own planning purposes, be a little bit more comprehensive in declaring their costs. So that's a very important watershed in what has happened. And one can say that that's maybe a good thing that's come out of the rapid decline in the gold price, forcing companies to reassess exactly what it does cost them to mine an ounce of gold. I think you'll also notice in recent months a buzz in the analyst community, in the financial press. People are asking the rhetorical question, is it now time to start buying gold equities again? I think as a representative of a publicly traded gold company, I would say absolutely. I think there is a lot of upside in investing in gold equities, especially given what I described about the change in attitudes and the change in approach to assessing the all-in sustaining costs of producing an ounce of gold. And the reason that gold mining companies are essential is that the demand for gold, whether for jewelry or for investment, has not abated. The prices have fallen, but demand is still high. And gold is a diminishing resource. It's becoming much more difficult, A, to find, and B, more difficult and expensive to mine. As long as people in the developed economies, and particularly in the emerging economies, China and India are the biggest markets for gold jewelry. As long as that demand lasts, someone is going to have to mine the product and deliver it to the refinery and have it refined into a form which is useful for jewelry manufacture. And the only entities that do that are the mining companies. So sooner or later, gold equities will have to rebound. The price will have to rebound. The real question is for individual investors is how do you select the right equities in which to invest? Which companies, most companies that are publicly traded are widely analyzed, and the analysts are very capable and experienced people. Ultimately, it is the individual investor that must decide amongst the gold producers what aspects about their reserves, resources, the jurisdictions in which they operate, which of those things attract the individual investor. But definitely, I would say that the low price will not last forever, and gold equities will also rebound consistent with the return of the ascension of the gold price. I spoke earlier about the catharsis that the industry has encountered or has experienced in terms of greater focus on cost effectiveness and reducing expenses. And I think if you look at all the major gold producers and even some of the intermediate companies, in their public disclosures, they focus on this quite extensively. In our own company, we started more than a year and a half ago with what we call the Kinross Way Forward and our continuous improvement program. what we did, which may not be typical, I'm not sure, but what we did is we engaged employees at all levels in this process, challenging everyone, encouraging them to make suggestions in their own particular sphere of activities, what they might recommend for the company to save money. And this has proven wildly successful. When you engage staff, people who actually know what they do every day, engage them in the process, and it challenges their creativity and it increases their engagement in what the company is involved in. And we have seen considerable success here in Russia, where our staff have come forward with cost-saving measures and then assume the responsibility for implementing those measures. And we've managed to save quite a bit of money. And this Kinross Way Forward and Continuous Improvement Program extends throughout our company in all 6 regions where we work. And we have managed to reduce our expenses quite considerably and have also reduced CapEx. We have reordered our exploration program in order to focus on higher yielding assets and where we do exploration. This is also the case in terms of our focus on the acquisition of new assets around the world. We have always been very scrupulous in reviewing all the information available on assets that are either owned by other mining companies or that have been recently explored. And clearly now the focus will be on assets for any mining company, any gold mining company, assets that can deliver higher grade and higher margins, and where the cost of everything from exploration through to development and production can be minimized. And I think that's a good thing. The real challenge will be going forward is when gold prices start to increase, will these companies be able to maintain the discipline that they have developed in recent months and years? That'll be the real test. Hopefully people can learn from their experience. At Kinross, we're very pleased with our Russian experience. Next year, in 2015, we'll celebrate 20 years working in Russia. Going back to our first mine, Kubaka in Magadan in 1995, and right through to our most recent mine, Dvaynoye, which was opened on the 10th of October 2013. We have experienced all stages of the geological chain here, starting from exploration through to development, through to production, through to closure and remediation, which is what we started at Kubaka before we sold that mine. Our experience has been extremely positive. In February of 2013, we marked the production of the 3 millionth gold equivalent ounce from our Kupol operations. And we were able to deliver our Dvaynoye mine from acquisition through to full production in 3 years. That's an unprecedented length of time. The average development time of a gold mine is somewhere around 8 years. And so we were considerably faster than average. And this says a lot about the quality of our Russian staff, our engineers, our geologists, and our miners. They're very, very productive, they're very efficient, and our Russian operations compare very favorably to what the way our company works in the United States, in South America, and in total we contribute more than 20% of our global production from Russia. And given the high quality of the mines, both Kupol and Dvaynoye, we contribute quite a good percentage of the company's profits. So our experience here has been very positive. Regrettably, and it's regrettable for Russia, a country with 25% of the world's entire share of minerals, that we are the only successful, significant investor in hard rock mining. And we have been engaged now for the last 3 years in a very constructive policy dialogue with the Russian government, and produced a couple of reports in which we try to share with the government, with policymakers, with the wider mining community, our recommendations for the kinds of reforms that, to the regulatory system, to the subsoil law, to the foreign investment laws, that can help to re-stimulate interest in investment from abroad in Russian mining, and particularly gold mining. Russia is squandering a lot of opportunities to open up exploration. Most exploration for gold here was done in the Soviet era. There's very little going on now, and by making some changes and some more liberalization to allow companies the incentives to conduct exploration here, not only can more gold be uncovered, but the government will realize an accelerated rate of investment and the production of the metal, of all minerals, for example, or in reality, with making very few changes. There's no real capital cost. It's a question of changing some attitudes, introducing reforms, going away from the Soviet model of even calculating reserves and resources to a more international standard. And I think capital will come here. There has to be a very definitive signal to other mining companies that Russia welcomes investment both in exploration and in mining. And our experience in Chukotka and in Magadan has been very positive in terms of the economic benefits and social benefits that investments like ours can bring. And we're very hopeful that the government will welcome the opportunity to get more of this type of high quality, responsible investment to help develop areas like the Russian Far East. This is our hope. Some people question, well, why are you doing this? Aren't you afraid of the competition? Well, in case you haven't noticed, Russia is a huge country. There are many opportunities. It's underexplored. And the more success that there is amongst mining companies, including Russian mining companies, in finding new reserves and resources, the better it will be and the better the economic benefits for Russia. And we're not afraid to champion these recommendations. There'll still be enough gold for Kinross and many others to find in the country.